Hey everyone, Ben Nelson here, the Everyday Real Estate Investor. Thanks for tuning in to another episode of the podcast. Appreciate everyone listening. Again, kind of reiterate every time, the goal of the podcast is just, everybody's different levels of investing, everybody has different goals, and there's a lot of pressure out there to be, some big time investor. That's great for a lot of people. It's not what everybody's after though, right? So, being an everyday person, a busy person with a career, job, family, all that stuff, and still finding a way to invest in real estate is a great thing. So that's what we're trying to encourage people to be involved and not use that as an excuse to not be involved in real estate. So I am here today with Evan Bellingar, and his wife Kim is not here with us. I'm assuming
she's sipping wine somewhere.
Oh, okay. I was gonna say she was maybe busy with the kids or something like that, but that works too. Could be perfect. Well, yeah, Evan and Kim have been in the wine industry for a long time, busy with their careers now, business owners, own their own winery, vineyard, and have a private label, all that stuff, which is awesome. So, and then I just mentioned the kids, so obviously busy with lots of things, but have managed to build a pretty nice real estate portfolio over the years, which is awesome. So perfect to have you on. I love the mingling of business and family and all that stuff, and still finding a way to invest. So thanks for being on the podcast.
Absolutely, thanks for having me. And I feel like I'm an everyday real estate investor, just with a few years of experience, and I still work a full-time job. And one of the great things I find about real estate is it doesn't always have to take all that much time. Like that moment where you're like finding a deal or like taking down a deal, that's critical. But like once you own it, it's not that time intensive going forward.
Right, yeah, absolutely. Awesome. Well, why don't you start off by telling us a little bit about your journey and just, where you started, when you started investing, kind of that first step investment, and then where you are today.
We did not, dream of being real estate investors when we got older. It was funny, my wife and I got married in 2007, which was kind of some choppy economic times, and then we purchased a house to live in October of 2008. So other than March of 2020, probably the toughest time in the last quarter century to buy a house, just in terms of like anxiety and fear and things like that in the market. Yeah. But we were pot committed, we'd been pending on this, and it was scary. And we were listening to Dave Ramsey at the time, and who has really good advice for a lot of folks. And so we had purchased this house that was a little bit bigger than we needed, 4-bedroom, and it was just us, and would be just us for a long time. And so we ended up renting rooms out of the house. So now you call that house hacking.
Right, yeah.
But
that was before house hacking was cool, right?
Before it was a hashtag.
Yeah.
It was just being poor and renting rooms out of your house. And so we were really aggressive on wanting to go through the Dave Ramsey baby steps, pay off that house. And part of doing that was, of course, both of us having a day job and then renting rooms out. And by the end of that season of renting rooms out, we ended up loving it. We ended up preferring it. If we didn't have so many darn kids now, we probably would continue to do it. I think we went to like 5 or 6 different weddings of people that we lived with.
That's awesome.
Several of which we're like friends with now. And
that's very awesome.
So it was really a blessing, really. And it helped us accumulate funds. We ended up paying that house off in about 4 years, being hyper intensive about it.
Wow, that's quick, yeah.
And then we kind of pivoted, and we're like, okay, Dave Ramsey would be proud of us. But the next street over, we'd continue to watch real estate prices, and the next street over, a house on a big lot was for sale for $60,000. So this was in now 2012. And we still saw like lots available in Newberg, and the price of a lot never really went below like 80 grand. And here was a house on a lot for 60 grand.
Yeah, it seems to make sense then, right?
It was like
one of those that makes sense. Like, wait, what's going on here?
And so we just kind of had this moment where it's like, okay, either the economy is truly going to crumble and we're going to be, eating rice and beans, not for a fun way, or like the market's wrong. It's just pricing these houses incorrectly. And the economy had started to feel a little bit better compared to like 2009, 2010, 2011. And so we decided, okay, well, let's pivot, and rather than keep this paid off house and the security of that, let's get a HELOC on it and start investing.
You went anti-Dave Ramsey.
Yeah, so Dave Ramsey and I, he no longer invites me over for dinner. But yeah, so we very much went anti-Dave Ramsey, and Dave might cry if he knew the amount of debt we have now. But yeah, so we didn't end up being able to purchase that property, but then we just changed our mindset.
But it set you up for looking for something else. Yeah.
Exactly. And so then at the time, which seems like a long time ago now, there was a lot of houses for $100,000 a door. I remember passing on several houses at $130,000.
Right, because it was too much.
It's too much money.
I can't believe they're asking that much money for that.
Oh, the rents are
house
only
is what, $450 or something like that?
Exactly.
Yeah.
Some of those same houses we passed on, $500,000.
Yeah,
it's
that's crazy. Yeah. Whoops.
Yeah. So we essentially started buying single family rentals, a couple of them. They started out as short sales, so I think we completed 2 short sales. They weren't short at all, it took like 6-9 months at the time.
That's the joke, right?
Yeah. And then prices, so we started buying in 2012, and then prices started to creep up. Single families were harder to buy. And so then it's like, oh, but there's still affordability with duplexes. And that lasted for quite a while. So our strategy ended up being doing a deal or two a year now for 10 years. And as some of our buying criteria have stayed remarkably similar in terms of like dollars per door and our cash on cash metrics, but to get that now, and we had to basically scale up in building. So now you can still buy, shockingly, pretty inexpensive doors, but it has to be part of an 8-plex or a 10-plex. The regular consumer buyer won't be able to.
Right, it's so competitive. Not that it's not competitive in that space, but it's hyper competitive in the single family home and duplex that space for sure. Yeah.
You're competing against 40 or 60% of the population for a single family house.
Right.
You're comparing against
extremely low.
Yeah, you're competing against very thin air with multifamily, just generally. And a lot of people that are big into multifamily are big into 30, 50, 100
the
units.
bigger, 100 plus unit or slightly under, for sure. Yeah. So you're kind of in that sweet spot, right, where it's like a little bit more mom and pop, less people looking at it, less institutional buyers looking at it, and big time syndicators and stuff like that. So yeah. Awesome. So I think so you kind of like almost stumbled into real estate investing, right? It's like, okay, how can we buy something and pay it off quickly? And then that's transitioned into like, oh, this actually makes sense, right?
This could be a business.
Yeah.
Absolutely.
Awesome.
And now, as a percentage, it's by far the vast percentage of our net worth and retirement funds and plan for the future in terms of economics and funding.
Awesome.
And so it's ended up being this vehicle that we did not intentionally get into.
Yeah, that's awesome. But you recognize the opportunity of it, and I love the like slow, steady plotting, because it can get there can be a lot of pressure to be like, I have to buy a bunch of doors right now, right? We kind of touched on that earlier. I've got to buy 10 doors this year. I've got to buy 20 doors. I've got to buy whatever that is. But just, hey, if we buy 1 or 2 a year, in 10 years, we're going to own, 10, 20, 25 units. And then now, like, you can scale up even more. You can leverage those to buy some bigger buildings, right?
Yeah, and it seems to it gets easier the longer you've been doing it. And like that snowball starts to get bigger and bigger. And people tend to call you. People call me with deals. Brokers look me up from properties I own and call me to ask me if I'm looking for more or if I would ever sell. And so you're getting into these circles, and it's easier. Michael Blanc talks about the law of the first deal. Once you do your first deal, the next one happens automatically, and almost you have to expend energy not to do it. Right. And that's kind of been true. Like once you're a doer of deals, the next one's easier.
For sure. Yeah, it's just getting over that hump of the first deal for sure. Yeah, and he says I know he's talking a lot of what he does is to like bigger, people that want to do bigger deals, syndication, that sort of thing. But he's like, just one first deal any size. It really doesn't matter what it is. But it's doing that first deal, and now you've got confidence, you've got some more knowledge, you've got connections, all of that stuff that's necessary to do more deals. Absolutely.
And who do you know that like invests in real estate and stops with like a duplex? It's always like, this is cool.
Not very many, yeah.
But it would be really cool, a 4-plex, an 8-plex, and 20-plex.
Yep, for sure. So I know you started mostly buying just local, like here where you live, right? Like here, which we didn't mention, we're here in wine country, right? With your grapes right out there, right? But you've kind of branched out into some tertiary markets, I think more recently, right?
Yeah.
And so tell us about that, and like what drew you to that? Was it just the numbers, or just, hey, this deal is like crazy, or was it a strategic thing, or what led to that, and then how is that working out for you?
Yeah, so it was driven initially essentially by affordability. We could buy houses for $100K a door in Newberg in 2012, and that hasn't been true for a while now in Newberg, as prices have risen. But I think of this valley, Portland's the primary market, and then the suburbs of Portland reflect that, and then we're kind of a tertiary market, and then further ones are farther out. And you've just seen this wave of appreciation kind of move down the valley. And so we started in Newberg and bought as much as we could and essentially could afford. And then I think our next venture out was maybe, I'll forget exactly which town, but then we ventured to McMinnville, where there was much more affordability.
That probably felt really far at first.
And it felt really far. I was like, oh my gosh, a 5-plex in McMinnville, which is just 20 minutes down the road.
Yeah.
And then Salem, which is maybe 40 minutes down the road in the state capital. And if I could tell myself any advice earlier, it would have been to broaden my reach earlier than I did, because I can't tell you how many like multifamily deals in Salem for $40,000-$50,000 a door I saw traded on like LoopNet, on Zillow for years. And then it's like, now that's changed to the upside.
Yeah, and I think another thing with that, like for people that don't know the area, and just as for people to keep in mind as they're looking in whatever market they're looking in, is there's not a lot of multifamily in the county that we're in here. In there's like duplexes and triplexes, but there's not really that many that are bigger.
Yep.
And bigger, I mean like even 10 to 20 units. There's just not a lot. But you go to Salem, you know, and you have a lot more opportunity like that. So looking at some of those next door markets, if you're wanting to stay kind of semi-local, is you could be missing opportunity if you're not kind of considering some of those other areas, right?
Absolutely. Yeah. And now we're in Eastern Oregon in one town, and we've kind of got a nugget there, which we're happy about 15 units. And then in Southern Oregon, about 15, 16 units as well. And so that's kind of helpful, where we've got enough that we could attract property management, which all of our stuff is under property management. But that was kind of a hurdle to go, you know, a 4-hour drive away. And part of the way we got around that was it's entirely reasonable for somebody, in my mind, for somebody to do out-of-state turnkey investing, like where it's like, okay, they're investing in St. Louis, they're investing in Florida, something like that. If I could get my head around Florida, why can't I get my head around Eastern Oregon? Why keep,
right.
you know, a 4-hour flight versus a 4-hour drive? Same deal. And so it was a bit of a hurdle for me, but then once we did, we realized there's a lot of cool towns in Oregon that have a lot of product and a lot of affordability.
Yeah. And I think the hurdle for a lot of people is like they want to be able to see it and touch it. But the reality is, I mean, the stuff that I own locally, for a while, you know, you drive by it and like, oh, that's cool, I own that, that's pretty neat, and you kind of check it out and what's going on. I haven't driven by those properties, and I don't even know how long, because property management takes care of it. I get my rent, and I'm doing other stuff, right? So the reality is you're really not, and if that's tempting to you, it's actually probably better to be. That's not the best use of your time, right?
Yeah.
So there's other things you should be doing.
If you were full-time real estate and you were a contractor and you were good and you had extra time, it'd probably be super handy to be really.
I don't do all those go together. I don't know.
Yeah, it'd be super handy to be close, right?
Yeah.
And you were in a good market would be the number 6.
Yeah.
But if any of those aren't true, then it's really, you're still going to have to hire a contractor. You're still going to have to go through all these processes.
Yeah.
So being there, you know, within 4 minutes, it's not as helpful as you'd think.
Right, exactly, yep. Yeah, I think that's a big thing for people to learn. So, okay, humility here. I'm going to ask you the question. Tell us about maybe a mistake that you've made other than not looking out wider sooner. What's something that sticks out as maybe a mistake that you made that you wish you could take back, but other people could learn from?
I'll do several.
Okay.
Yeah. So one, I think everybody says it is, you know, I should have bought more earlier.
Sure. Yeah.
But some of that is also, we've been pretty aggressive in putting our net worth towards this project, and which has grown our net worth. But, you know, I know a lot of folks that, you know, they're like, oh, I want to, and we used to think this, balance stock investing with real estate investing. Well, at some point, for me personally, I would rather, you know, have my eggs in one basket and then watch that basket and have control. So like, to an effect, it's betting on myself to say, okay, I'm in real estate and I think I'm good at it, so we're going to do more of it.
And it's hard to be good at multiple things. I mean, investing is investing, but it's not. I mean, there's similarities, but there's a lot of differences between even like the strategy and the mindset and all that between real estate and the stock market, right?
Yeah.
So to try to be really good at the stock market and knowing what to buy and when to sell at the same time as trying to do real estate, especially if you're, like we're talking to a lot of people, you're already busy with family and your career and all that. People do that full time.
Do I need to be trading
watching,
options?
Right. It's
2 a.m.?
really, exactly. Yeah, especially right now in the stock market, it's so volatile.
Yeah.
It's like there's opportunity there, but you have to know what you're doing.
And if you're really good at stock picking, you should probably do that, right?
Right.
Like pick your pony and find out if you're good at it, and then go for it.
Yeah.
So that was kind of one broad, thing I would tell the younger me. And then another would be, I tend to like underwrite pretty quickly, thinking that like things will turn out well for me, which generally they do. But where that's bitten me financially has been higher than expected repair costs. And I'm like, just me and my ignorance and optimism just being like, oh, how bad could it be? Well, it turns out pretty bad.
Yeah.
And that's led to kind of some moments of being tight on cash. And like, to me in a surprising way that like, it's like 6 months to a year after closing on kind of a heavy lift remodel, because it's like the day of closing, you put out your down payment, but typically our properties have been occupied and it takes a while for those to cycle out and then put in what used to be, $10,000 a door, and now is more like on a heavy lift, $20,000, $30,000 a door.
Yeah.
It's like, well, it doesn't take a lot of those to start being very challenging.
Right.
And so like I've created a lot of stress for myself by not prepping for that. And so like nothing is stressful if you have enough cash reserves and if you know what's coming.
Yeah.
And so that was definitely a mistake where it's just like properties had been tens of thousands of dollars more expensive than I was.
Yeah, and I think one of my bigger mistake projects was kind of along that lines, where it was like, oh, there's opportunity here, I'll just buy it and I'll figure it out later. And it's like, I mean, I would say you can be overly like, I need to figure out all of the, you get the analysis paralysis, or you're just, I got to figure out all the details. You don't want to be too far that way either, but you definitely don't want to be, Wild West, just like, oh yeah, whatever. Well, there's opportunity here. I don't know what it looks like necessarily, but I know I can do something with it, and I'll just figure it out.
Yeah.
You got to at least have some plan moving forward.
Yeah, my wife Kim heard that phrase, analysis paralysis, and she was asking like, "What is that?" And I explained it to her, and she's like, "Oh, you don't have that." It's like, oh, okay. Yeah. So it's kind of like a shoot then aim kind of thing.
That's funny.
Yeah.
That's funny. What's been one of your main keys to your success in building your portfolio?
I would say a big part of it is like consistency and having this vision for what it can do long term. We kind of backed into it, but having a long-term plan, and for a lot of years we did 0, 1, or 2 deals a year, and so it wasn't that impressive for a long time. But then after that's really started to work, it's really significant.
Yeah.
Yeah.
What's been one of your highlights of your investing? What, a certain deal, cool story?
We feel very lucky to be on this property, and it really came, there was a lot of really cool kind of God moments in getting this property, but one of which was this property we're on. Now it's our home, our estate vineyard, and there's 4 duplex units on it. We would not have been able to purchase this property if we had not been investing in real estate prior to purchasing it. One, just to have the funds to do it. Mm-hmm. And at the time we did like 3 or 4 cash out refinances while in escrow on this to get the down payment to take this down. And this was also on a commercial loan, and we had started getting into commercial loans prior to this. And so that banking relationship allowed us to be able to take it down. Because if we'd just seen, okay, commercial property, I don't think we would have had the mindset to be able to do it, or the banking relationship to be able to take it down.
Yeah. You see the opportunity because of the experiences that you've had before, right? Yeah. Our primary residence was very different, but similar in that, like, if we hadn't done our prior investing and learned the things that we had, we would never have been able to do it, because we actually seller financed for a while on that one, and it was definitely a scenario where it was like, well, it was kind of, like you mentioned, God putting the pieces together, right? Where it's like, this shouldn't work, but somehow it did. So we asked the question, and they said yes, but we wouldn't have even known to ask, right?
Yep.
If we hadn't been doing that prior stuff.
And if you'd been a good boy and girl, like saving up your down payment, at least in our experience, like the price appreciation outpaces our savings rate, really.
Right.
And so there's like, if we were trying to save money to purchase a nice property, it wouldn't happen. And with every year in the market we've been seeing, we've been getting further away.
Yeah.
And so you kind of have to be a doer of deals to do more deals.
Yeah, awesome. Do you want to talk about one of your better deals? Just like a couple.
I'll talk about a recent deal.
A recent deal? Sure. Yeah.
Yeah. So I pulled up some numbers on our first mixed use property. So beautiful property in a small town in Southern Oregon. And I was comping a different property, and this was on Zillow. And this was in 2021, so just last year. And so as hot as the market is, and it is quite hot, generally, like it was blindingly hot in 2021, but this was on the MLS, it was on Zillow, and I didn't see it the day it popped up. I was just cruising. So all that to say, there's opportunity out there. 2 apartments upstairs. It's an old, beautiful brick building right on Main Street, and 3 commercial units downstairs. So price was really compelling. We ended up being able to purchase it for $357,000, and we took it down with a bridge loan. And the commercial made it challenging to fund, basically. My normal bridge loan guy couldn't do it because it was more than 50% commercial by square footage.
Okay.
And
yeah, all the interesting nuances of financing, right?
Yeah. And so rents when we purchased it were just under about $3,000 a month. And so we thought at the time at that current cap rate, a value of about $408,000. So we felt like we were getting a discount for it when we purchased it.
Nice, yeah. Awesome.
And
you're increasing rents on that?
Yeah, so the residential units, one tenant vacated, and then the other one, it was essentially unlivable. And so that got changed out. And so 2 pretty heavy lifts of renovating the residential units, put in probably about $45,000 in repairing those and getting them up to a beautiful modern standard. And so we've only moved rents on those 2, and as have cycled to new tenants. So one apartment at purchase was renting for $650 a month. Now that rents for $1,600 a month. And the other one had been rented for $500 a month, and now $1,100 a month.
That's a pretty good jump. Yeah.
Pretty good.
Nice. And at that same cap rate.
So on that same cap rate, it really bumps the value. As you know, the magic sauce of commercial is if you increase the net operating income, you are increasing the value in a big way because you get to divide by the cap rate. And so
it's based on income, not what the guy down the street.
Exactly.
At least not in the same ways.
And so if you can raise the NOI by increasing through renovation or however, or bring it up to market, that's been a big thing for us, just knowing what the market is.
Right.
Some landlords are like, these are, I don't want to bother anybody, so we've been leaving rents the same for 10 years.
Yeah, especially recently in the Portland or anywhere, a lot of markets, if you've got someone that's owned a building for a long time and just maybe hasn't been paying attention, I don't know how you don't see what's happening with inflation and all that stuff. You have to have your head in the sand or something like that. But there are people that just don't pay attention, or they don't want to mess with it. And I'm getting enough. I'm getting enough that I'm paying for my retirement or whatever that they're doing with it, right? So why mess with a good thing?
Yeah, and by all means they don't have to, but there's a huge, there's literal value created when you bring rents up to market. When you decrease expenses, you are creating actual value that you can show to an appraiser, and it's real. So we just got an appraisal on that. So purchased for just under $360 and now appraised for $570,000.
Nice. Awesome.
A year later.
So. Very, very cool. Yeah, and that's obviously enough where we don't have to get into nuances out, but if you wanted to, you could, pull some cash out, right? And you've got more cash to work with. Because you got enough equity there that you could pull out your initial investment and keep running.
And that's essentially one of the things we've always done, and that's how that snowball can continue, is essentially a cash out refinancing as much as you can. As sheepish as I am to say that, but particularly, and there was a lot of years where rates were coming down, so you could increase the debt, take cash out, and in some cases your payment went down.
Right, yeah.
And it's like...
Yeah, we're not seeing that right now.
I was like, I could do that all day long, and that's what I was doing.
Exactly, absolutely, yeah. So, speaking of that, so obviously we're in a changing market. Interest rates have gone up significantly. From your perspective, what do you see? Because you're always looking at stuff, right? You're always looking at deals. Are you seeing any changes in what you're seeing in there on the market for deals? And what do you see happening from your perspective and experience here moving forward?
Yeah, I certainly think we're going to see softening in high-end residential. Just looking for a friend for a house, and you're seeing some price cuts and price adjustments in the like $1 to $1.5 million range, because
single family,
so mortgage rates went from 3% to 6% in a few months.
Right.
That's incredibly challenging for the buyer. But I don't
huge difference in payment.
Yeah, it's
huge difference in payment, especially in that.
But I don't see a crash because I don't see any desperate sellers, and I don't see that many of them. There'll always be some number of folks that are moving out of state, passing away, and then the heirs have to dispose of it. Change of life things.
Mm-hmm.
But if that's a small percentage of the market, that won't crash the market having to sell.
Right.
But other folks, if they have a price in mind that they want to get, and they're not getting that, they don't have to sell it generally.
Right.
And the great crash of 2008 to 2012, that was a compounding of a lot of factors, and we're not seeing those factors right now.
Yeah, I would agree. Yeah, and I always toss out the wild card is, in my opinion, is if banks get really sketchy again, or if they get really scared and they start pulling funding or making underwriting very difficult, making it a lot harder to get money. That's essentially what made I don't think caused the crash, but it made it a whole lot worse because people couldn't refinance. People couldn't buy because you couldn't get money. So if that goes away, all the other stuff doesn't. I don't want to say doesn't matter, but it's a lot harder, right? To get money, you can't purchase property if you don't have money. You can't buy. So that's my wild card that I always throw out there. I don't see that happening. But that's the one thing that we don't necessarily have control over, right?
Absolutely. And I think on the multifamily side, I think we'll see some price softening, like on a price per door. But something to think about is you look at the cap rate formula. Cap rates can go up, which normally means your price is going down. Cap rates can go up and sellers can still make money, or buyers can still make money, because essentially your rents can go up. Your total NOI in dollars can be going up.
If you have still rising rents, even with rising cap rates, you can
still make money. It can still be a good deal. And so, because yes, on your formula, an increase in cap rates would, at the same rents, lead to a decrease in value. But over time, if you expect rent to increase, you can still make some money there. It's definitely a headwind, but doesn't kill all these businesses.
Yeah, very true. Yeah, and I think rising interest rates will also affect cap rates, because most buyers are buying with debt, and so if your debt gets more expensive, it gets harder to manage that with the income of the property. So
absolutely. So higher interest rates, another way to think about cap rates is unlevered return. So it's okay, a 6 cap is not counting your principal and interest portion, you get a 6% return on that money.
Right.
And generally most folks would, if you're borrowing money at 5%, then you could probably pay or want to pay a 6 cap and have a little bit of room in there to make money. And so interest rates at 7%, you would probably want an 8 cap kind of thing.
Yeah.
But rents can bail you out a little bit. We shouldn't be expecting the market to do that, but you can raise rents by improving properties, more amenities, and looking in markets where you're not building more units and populations are growing. And there's a lot of towns and states like that.
Absolutely. Yeah, and that's an important thing to look at, and is what's the future inventory look like in the market? What does the net migration look like? What do jobs look like? Are incomes growing? All of that stuff, because all of that factors in then, right? If you have a stagnant economy, local economy, where wages aren't going up, you can't really expect rents to continue to rise if people are kind of already maxed out, right? But if you're in a market where people still have some disposable income, maybe because rents haven't quite gotten there yet, and high wage jobs are coming in, all that stuff, you have a higher likelihood of that kind of stuff happening. Yep.
Yeah, absolutely.
Awesome. Well, what advice would you give to someone that might be listening that is either newer to investing, trying to get their feet wet, get in their first deal, or maybe they've gotten their first deal or two, but they're like, how do I scale from here? What are my next steps? What advice would you give from your experience?
Something I wish I'd done more of earlier is networking. So joining local RIAs, even starting a local RIA if there's not one around where you're at, and I go to Yoria, which is really fun. And
which isn't here in a little bit, right?
Isn't here in Bellingar. But just seeing, like, podcasts are great, books are great, but particularly books, they're so out of date so fast. But if you can talk to somebody once a week or once a month and you're realizing, oh, well, I'm finding deals in this town. Oh, I'm seeing these cap rates move here, or a lender like, actually interest rates are here, that changes so much of your underwriting. The more you can chat with folks and see where the market is, that's a huge advantage.
100%. Yeah, not to mention that it's a relationship business too, right? So, I mean, unless you're buying notes over the internet or something, I mean, can you do that? I don't know no buying at all. So, but I mean, people do that kind of, but it's really difficult. Most of your success in investing, most of the time you're going to have you talking to brokers and out there looking at stuff and actively engaged, right? So you can't do that behind a book or behind a computer or listening to this podcast. Keep listening, but get out there and do it.
Yeah, absolutely. There was a point where my network was me and Zillow. And once it became me, Zillow, and a lot of friends and brokers and real estate agents and property managers and appraisers, that's when it became so much easier.
Yeah, and that goes back to your previous comment too about it builds on itself, right? Well, it's a lot harder for it to build on itself if your relationship is just with Zillow, right?
Yeah.
Well, I found a deal, but it was all online. Okay, well now you got to go out there and do that again. Well, if you find it through a broker or something like that, now hey, this person, I know this person buys, I'm going to go find them something else, right? So you got an extra set of eyes looking for you instead of you having to do all of it and recreate it again. So.
Yep. And to piggyback on that, particularly lenders. Lenders are great folks to keep chatting with and keep networking with, because lenders, to broadly generalize, oftentimes think about the world in like the box they can lend in, as opposed to what you want to do or what you're trying to do. And so the more lenders you can talk to, the more you can realize, oh, for this kind of property, he can lend on that all in. But for this other thing, I need to call her at this local credit union.
Yeah.
But if you don't know that local credit union has those products, you don't know that you could take a deal like that down.
Right. Yep, absolutely.
And sometimes they change, where it's like, our bank's not trying to do this type of product right now. Okay, but down the street there's a bank that is.
Yeah. Yeah, and because they know and they refer each other business, right? Oh, we can't do that, but they can, and vice versa. So so get out there, talk to people, get engaged, basically, build relationships. Awesome, good advice. Very good. Well, hey, thanks for joining us. Appreciate it. I hope everyone's learned a lot and been inspired. And again, I love the slow, steady pace and look where it's gotten you to buying lots of doors. I don't even know how many. Are you willing to share how many doors you have? Not that we're all about doors.
Not that it's all about doors.
Yeah, we know that, but
I think today we're at 71.
Awesome. Yeah.
And
it all started with one house hack.
And probably I would need to check the numbers, but in the last year and a half, 2 years, it's essentially doubled. So it's really had a growth.
Exponential growth. Yeah. Awesome. Yeah. So keep at it. Don't frustrated, right? Just keep plodding away. Buy that first deal to the next one, and just keep growing that portfolio. So awesome. Well, thanks again for being here. Appreciate you sharing, and thanks everyone for listening.
And follow me on Stacking Units.
Yes. And if you're in Newberg, at any point, stop in at Bellingar Estates.
Yeah. If you like wine, Bellingar Estates. Also follow us at Bellingar Estates.
There you go. Very good. This is Everyday Real Estate Investor out.